I'm pleased to be joined by my expert panel here with me today, each luminaries in their respective fields, and also online with David. So tokenization, right? So those of us who have been in the field of DLT, tokenization is no new facet to us or new idea. However, of late, it has risen to prominence through projects such as the BIS project Promessa, if that's how you pronounce it, the tokenization of promissory notes. And then also the unified ledger itself has tokenization at its core. And today, I think it's important that we maybe just set the stage for the discussion on tokenization. I know we've heard quite a bit about it, but do we really understand what this means? Is it one single thing, and have we all kind of established our understanding around that? And but before I get kicked off, let me allow my esteemed panelists to introduce themselves. We'll start maybe to my immediate left, and once we get to the end, we'll jump online. Varun, over to you.
Hi, thanks. I'm Varun Paul. I am Director for Central Bank Digital Currency and Financial Market Infrastructure at Fireblocks. Before this, I spent most of my career at the Bank of England, working most recently on things as head of the FinTech Hub on things to do with the future of finance. And now at Fireblocks, I'm helping to take that technology, which is really a cybersecurity technology designed to secure private keys in the digital asset ecosystem, to the heart of the financial system across central banks and FMIs around the world. And glad to be here today.
Thank you. So I am Javier Garcia. I am leading digital assets markets at Intellect EU. We are a fintech company that focuses on capital markets innovation and payments modernization. Most of my career as well has been more focused on the capital market side. And in the last 3 years or so, I've been just focusing myself on different use cases around tokenization of financial assets. And yeah, I think that's mainly it.
Thank you. Hi, everyone. My name is Murat Farizov. I work for Moody's. I think most of you know what Moody's is, so I don't need to explain it. I am part of digital finance team at Moody's. So what we do, we give risk assessment to instruments issued on the blockchain, and we also see how Moody's can integrate into the blockchain infrastructure globally.
Great. David, please introduce yourself if you will.
Hello, thank you for inviting me. I'm David Durouchoux. I'm Deputy CEO of Societe Generale Forge. I've been in the capital market since 2008, and especially part of the founding team of SG Forge since 2018. And today we are a regulated subsidiary of Societe Generale. And we have 2 agreements to operate in Europe, which first one is an investment firm managing capital market products, regulated like traditional MiFID products, and what could be a kind of VASP pre-MICA agreement by the French regulator to manage what is about non-financial assets, digital assets. And we've been issuing stable coins recently.
Great, thank you so much, David. So before we delve into the nuances around tokenization, we're going to get into some of the technicalities. Could we maybe just get the definitions sorted out here? If I had to ask each of you, could you please explain in layman's terms what is tokenization in the context of commercial banking or financial institutions, and perhaps why? And but draw on your own experiences. I'd like to see if we've got a consensus here around the definition. Perhaps if we could go first with Javier, and then we could take it to the offline panelists, and then we'll jump to David at the end.
That's fine. Thank you. So normally for us, and when we talk about tokenization, we are referring to creating a digital representation of an asset on a shared or distributed ledger, right? So within this formal definition, there are many things that need to be taken care of. And normally, this involves a lot of understanding on what a distributed or shared ledger is. And also from a regulatory perspective, there's something that we also need to take into account, which is those assets need to have the same benefits for the holders, for the same claims that they have in real life, right? And this is something really, really important that regulation is trying to make sure that this happens. Also, more from a technical perspective, when we talk about tokenization, we usually involve blockchain technology, and what we normally do with our clients is just to try to make sure that representing an asset in a digital manner also tries to make sure that all the life cycle events, all the behaviors that this asset has needs to be also be represented there. That also then involves more questions around what needs to be on-chain and what needs to be off-chain. But this is kind of like the conversations that we normally have, and normally just to make it like very, very simple is like, it's a digital representation of something that we're doing on a distributed or shared ledger.
Does anyone want to add to that, or have you all kind of agreed?
I mean, that's a pretty comprehensive definition, but let me say a few things about what we see. And I think when we speak to banks, they engage in tokenization for two reasons, right? Either they're trying to increase revenues or cut costs. And when they're increasing revenues, it's because they can access new markets. Think things like markets like carbon credits that weren't previously possible. Or accessing new clients and customers through, for example, fractionalization. And those are the kinds of benefits on the revenue side. Meanwhile, on the cost side, there's the potential to save costs through automation, through improvement and settlement. And to do that, they then, as we've heard a lot today actually already, it's no point just tokenizing an asset, you need the money on chain as well. And then you can do the clever logic to enable that automated settlement process and so on. So just to add to what Javier said, I think those are some of the drivers behind the tokenization.
Great. Do we have anything from your side, David, perhaps?
Yeah, sure. It was a very good definition of a tokenization. What we see as we see two things in the tokenization. We see the tokenization of existing assets, and obviously the question of the illiquid assets comes into play. And so it's called an asset-backed token, and we see as well the native tokens. Those are the two that we are manipulating and what we see today in the market. What we expect from that is to, as was said, increase revenue and cut costs. The favorable effect of the cost cutting is to have a settlement which is pretty instant. And like the previous panel, we can extract as banks many efficiencies from that, because today we are facing a lot of fails into the settlement systems. And if you can try to patch it the way you want by running a lot of consultancy firms, etc. But at one point in time, you are facing limits. And one way to escape from this limit is to create new infrastructure. And this new infrastructure, you have to think things differently with an atomic settlement. And especially in the refinancing business, we see a lot of potential for that. Obviously, if we can find as well digital money to face with the security during the settlement.
I think I can add a few points from Moody's perspective. So as you know, we rate debt globally, right? So for us, tokenization is important from the tokenization of debt perspective. So it can be digital bonds, which were very active. I think last year, the number of digital bonds was quite significant. Moody's rated quite a few of digital bonds. Last year, we also noticed the tokenization of funds, and Moody's was also active in this area. So I'll just say a few words about tokenization of fund, how it works. So to give a perspective to everybody here, so it's just when you have an investor with, let's say, cash or digital cash, stable coins, that they want to have exposure to assets, like financial assets. So they would bring this cash to a fund manager, and fund manager would use this cash to purchase some assets. It can be T-bills, it can be corporate bonds. At the same time, they would mint some tokens and distribute it to the investors. So this token would represent the ownership of unit of the fund, And whenever the fund is, again, this token is redeemed, the return process happens. So basically, the assets are sold, and fiat or stable coins are transferred back to investors. So this is what kind of Moody's is looking at when we assess tokenization, obviously the risks of tokenization.
Great. I think we've got quite a few perspectives going, and we're in the thick of it, so to speak. David, I just want to touch on a point that you mentioned a bit earlier about liquidity. We do know that often we hear that tokenization brings liquidity to assets that are previously known as being not very liquid or illiquid, so to speak. Could you maybe just touch on how that is facilitated, or what mechanisms and functions are required to facilitate that liquidity within a rather illiquid market?
Sorry. Sorry. Yes, we are working on that. I think there was it was a start of the reflection within the banking industry since a long time now to make things liquid from illiquid markets. There is here a matter of chicken and eggs, nevertheless, because even if you add a layer of technology, if a market is naturally illiquid, meaning that you don't have a lot of issuers, you don't have a lot of people doing the market making, the price discovery is very complex, or even the settlement comes in many weeks for some assets, or you have physical delivery, meaning you won't, let's say, just by adding technology, make things liquid. We have to find ways, let's say, to identify, and that's precisely where the banking industry is struggling concretely to identify new revenue models and new revenue source, to identify assets which through technology could be made liquid. And that's why I was speaking about all the refinancing market, because the bank traditionally are dealing with many sources of collateral, and they manage a balance sheet from short term to long term, and they are doing, let's say, capital transformation, and that's the core of our business. The problem of that is we have to back to back from one very HQLA asset, etc., with another one which is less liquid, which has not the same market, probably not the same ways of delivery. We are doing on one hand on sovereigns, bonds, which are rated, listed the way you want, and on other hand, managing hedge funds, shares. Sometimes we are doing by fax for settlement. So we are managing that on a daily basis. I think that the potential we see in the tokenization of economy is precisely this one. You have only one layer for all assets. Not all will be native. Today we are focusing, Societe Generale Forge, on issuing native tokens, especially on public blockchains, because they are everywhere, and we can add ESG information. We can do new types of structuring, etc. So that's a part of our business. But we are focusing as well on tokenizing existing assets. And if we manage to have one pool and one way of settlement between those two types of assets, then as a banker, we will do the natural transformation and settlement between those two assets facing the two parts of the market, and then optimize the balance sheet. We have in the balance sheet of the bank many liquidity buffers, which are there precisely to cope with those, let's say, inefficiencies of the market. And today, clearly, there are use cases which are being studied to optimize that, and it's a way for us not only to cut costs, let's say, from an operational perspective, but also to improve the management of our balance sheet.
Thank you, David. Perhaps pivoting to more the technical aspects of implementation of tokenization within legacy banks, let's just say. David was talking about the bringing on-chain or the tokenization of existing assets that exist off-chain, and then, of course, the ones that exist natively and that are birthed on-chain, let's say. So, Javier, if I had to maybe just turn to yourself, and I'm also having a look at Varun here, with regards to the integration of tokenization within an institution, what are the interoperability or technological challenges from an interoperability and security perspective? Because I would imagine that bringing assets into a new realm would open them up to potential new threats. So how are these mitigated? What are the challenges, and how do we overcome these hurdles?
Okay. I'm just laughing because interoperability seems to be the mostly widely used word these days, and I'm happy about that. I'm happy about it because I think everything is interconnected, like even liquidity that David was mentioning is even connected to interoperability, because at the end of the day, there's no point on issuing a product on a siloed network that I can just buy and I can just move anywhere else, right? So that's why interoperability is really, really important. We see financial market infrastructures and even financial institutions looking at interoperability in a way that they really understand that the future is going to be multi-chain, and multi-chain doesn't mean that every bank is going to have a different chain. Is that even within a bank, there could be different chains, right? So what we are looking with our clients is how can we build all those bridges to make sure that all the different networks can speak one to the other. Same way traditional trading systems communicate with back office systems, with risk systems, with accounting systems, and also how can we make sure that these systems can communicate with traditional payment rails. And the reason why we believe that this communication with traditional payment rails is really, really important is because we've seen it today. We still don't have an on-chain representation of cash, so we still will need to use some of the traditional payment rails that we currently have. In reality, we have been discussing today a lot about wholesale central bank digital currencies. And today, we already have systems that allow banks to settle money instantly. Like here in Europe, we have TIPS, and banks can settle money instantly between them, right? So internally, we're also building our products to kind of like facilitate this interoperability between not just the networks, but also with traditional payment rails and also traditional legacy systems. And for the security side, and I'll just pass it to Varun, there's also something really important that we're looking with financial institutions, which is we all understand that probably the future is going to be on public permissionless networks, decentralized networks, but still, because of regulation, we have to deal with private permission networks, and that involves a lot of concerns from a security perspective. And normally, when you want to stop setting up your networks, you have a lot of network providers that can host that network externally as a software. And normally, financial institutions have that clear question, like, what do I do with my data? Is my data just traveling around the world? How can I keep that information inside? So there's an exercise with financial institutions, with market infrastructures to make sure they understand the importance of having those networks on-premise, to having those networks within the infrastructure, and what they need to do in order to manage that network. Because that's a really important role that probably for them is pretty new.
Two big topics you've dropped on us here, interoperability and security. So the interoperability question is, from a business and a technical perspective, is a big one. The irony here is we're talking about using blockchains, and yet we end up with challenges of creating islands. We create new islands which end up locking up liquidity in different parts of the system. Sometimes that's because they're proprietary interests. We have banks around the world who are setting up their own infrastructures and saying, well, use my thing, it's the best thing. And then sometimes it's because you've got technology companies saying, use my thing, it's the best thing. And you end up creating these pools of liquidity which are trapped. And then we're losing half of the benefit, the promised benefit of the technology. So actually, I think the most informed conversations we have with institutions around the world are ones where they say, I know where the future is going. It's going to permissionless chains. And I also recognize that we have to step along that journey. And so some of those have said, okay, well, I want eventually to go to Ethereum, but there's a regulatory journey here, so I'm going to start on a permissioned EVM chain. And that's a really positive step forward, and there are bunches out there, and it's not proprietary, you can have many different ones, and they are interoperable. And that's a great step forward. But the other lesson that we've learned, actually, is that risk committees within banks are willing sometimes to go on Ethereum, issue money on Ethereum. We've seen that in Australia with ANZ Bank and National Australia Bank that we've worked with. And the reason they got comfort with that, the risk committee is comfortable because once they learn that there are degrees of control that you can build in, not just in the smart contract. On top of that, the governance you have off-chain with a company with the technologies that exist, and we provide some of this stuff at Fireblocks. But the on-chain and the off-chain controls really gives that extra degree of comfort, and so you can do things on permissionless chains as well. So it's really important, I think, for us all to remember that the interoperability in financial systems is really key to the future. And so the more we can build in a world that is interoperable, the better. And there are security technologies out there that can support that vision. And yes, we all need to move step by step, and so we need to bring the regulators along with us. But it's really important that the biggest financial institutions in the world also understand the technology and can help lead in that right direction.
Great. I think maybe just staying with you, Varun, we talk about transparency, we talk about risk. These are some of the, or risk management, but also from a transparency perspective, we know that some of the claims that enhanced transparency is something that tokenization could, bring to an institution. Could you maybe just unpack how that takes place? I mean, especially in the wake of some of what we've seen early last year with the collapse of certain, stablecoin issuers and these types of things. Not to cross paths too much, but what are some of these aspects that tokenization can bring to enhance the transparency and risk management, around things like proof of assets, liabilities, etc.
Yeah, let's go back a step there. I mean, the true promise of the technology is that you can have transparency and that everyone in the ecosystem can know what's happening at any given point in the asset's life cycle. And so that's really powerful, especially in complicated either supply chains or complicated transactions. And that transparency does generate trust. Let's not forget that, yes, we had some stablecoin issuers go bust last year, but we also had some banks go bust. And trust is critical in financial services. So if we can get to a stage where we are using the technology to enhance the transparency of the transaction in each stage, then I think we are moving in the right direction. And we've talked a lot today about, for example, fully backed stablecoins. And something that I've been focusing quite heavily on is that if you can have a system where money is fully digital, you can have proof of reserve that is built into a smart contract, for example. You can build transparency into the token, and that will generate a completely different type of trust in the future than we have today. That's not to say that we need to do away with regulation. I'm a former regulator. I believe in the trust that we've built for centuries in financial services, but we can add to the trust by using the technology and building some of the logic into the smart contracts, for example. Beautiful.
So maybe just pivoting slightly, Marat, I picked up earlier that you were talking about tokenized funds, and I believe not so long ago Moody's rated a tokenized fund. I mean, I'd be very keen to hear more about that, but also just augment that perhaps with the competencies that fund managers now require to manage, a tokenized fund, something new. Are they any different to the existing funds? What might those be? But please take us through the rating of the tokenized fund first.
Yeah, absolutely. Happy to do so. Actually, great point about transparency that you brought up. I'll talk about it when we speak about the tokenized fund, because it's also very important in our view. To your point about the fund managers, I think many fund managers now exploring blockchain technology, they have to face these technical difficulties in terms of how to manage these tokenized funds, right? Because they have to deal with operations that they normally are not familiar with. So you can think of like, minting tokens, distributing tokens, burning tokens, redemption of tokens. Also, you would think of KYC that should be kind of recorded for whitelisting wallets, blacklisting wallets. So all these operations are very new to fund managers, right? And then, coming back to transparency question, I guess blockchain technology gives a unique opportunity for token holders so that they can easily see how many tokens have been minted and, calculate the percentage of the tokens that they own to see what is their share of the fund that they invested in, right? And they regularly get this net asset value report, so you can see really how much assets are within custodian and what is your share of those assets by using blockchain technology and open source of the technology, right? Another hurdle that we have with blockchain used for tokenized funds is the smart contracts. So we see there are a lot of hacks, vulnerabilities within the smart contract. So from our perspective, actually it's safer if those smart contracts are being audited. Not even maybe the original smart contract, but every modification to smart contract. So people need to make sure that all the changes are there, properly audited, and it's functioned as intended. So what we also look as a rating agency is kind of, are there any incentive for hackers to hack in and steal some tokens? For example, now we don't have really secondary markets. Even if the hacker steals the token, what's going to happen with the token? They cannot really sell it, right? They cannot really redeem it. So the token just sits there with their wallet, and then they're not being able to do anything with it. So it gives us some security at the moment, but it doesn't mean that in the future we will not face these issues. So we already need to start thinking of those security questions that appear when we think about it. In addition to it, another complication is the investment cash that they would use. So in many cases of those funds, they use stable coins. And we think it's more secure if the stable coin is converted to fiat before it reaches the ecosystem of the fund, right? So you kind of push away the stable coin DPEC risk. But there are also some cases when fund managers, they want to keep stable coins in the reserves. So if, for example, they need liquidity to redeem the token, let's say during the weekend, they can use these stable coins for that. So we also need to account for risk of DPEC of having stable coins in the reserves, right? And plus the assets themselves. So normally the fund that we rated, they were investing in treasury bills from Singaporean government. So it's kind of very secure asset. But let's say if they invest in stable coins or some other crypto assets, then it changes the picture drastically. So again, there are many aspects to look into it, and for fund manager, it's quite a new area. But again, for us, it's important to learn all these steps and also explain to investors what kind of new risks they face in investing in these funds.
Great. I think we just have a little bit more time left, and I think with that, maybe we should look to the future. Considering all these new innovations, different forms of rating, different forms of risk, different forms of opportunities, perhaps if each participant could, or panelist rather, share what they see the future of tokenization and doing to traditional banking. What does it do to the traditional bank? What does it do to new entrants, and how do those harmonize with traditional banks, et cetera, et cetera? Perhaps let me start with David. Online, you've been hanging on there for some time. Maybe just a quick 2 minutes look into the crystal ball for us, if you would.
Okay. What we see first is since 2018 and before, we see a convergence between the fintech ecosystem and the traditional cryptocurrency or crypto asset ecosystem and the banking world. There are more and more porosity between those two worlds due to individuals moving from one world to another, etc. And as well, with the regulator, his role is very key in that aspect because the two worlds have a lot to learn from one to each other, meaning that the fintech and the traditional cryptocurrency world has to learn from stochastic mechanisms, risk management, auditability of the smart contract or the reserves, etc. And all what makes finally the trust. And we are professional of doing so in the banking world and moreover in the financial sector. From the financial sector, can learn from the fintechs let's say, more agility, new technology, obviously. And I think there is a lot of creativity which has been put in the crypto space system since 5-10 years. And I think this, for us, it's an enormous opportunity because our big firms sometimes are lacking of new ideas because we are siloed, because we can't think out of the box, etc. And I think that the two worlds, we see a convergence, and that's precisely why within Societe Generale Forge, we have one foot in the traditional fintech, traditional regulated ecosystem and the fintech ecosystem. And I think that the regulator has really a role to play here to, let's say, push forward and to drive securely this innovation so that the two worlds can benefit from each other by concretely creating favorable regulatory ecosystem. And we have seen that through the pilot regime, through MICA, the FMI sandbox, etc. It's a good start. They are in their role. They take it seriously. I think we have a lot of ideas for them to move forward. And if there is a message here, we need the regulator to be conscious that this innovation has to be secured and has to happen and to benefit from a favorable ecosystem.
Great. Varun?
Yeah, David mentioned a couple of things that are really important. The two ecosystems he mentioned. I think the word of warning. I think the opportunity is great, but I think we all need to move in lockstep. So that's the central banks and the regulators need to provide the right framework, need to provide the money on chain as well. I think the CBDC is a big part of this. On top of that, the banks need to push forward in a constructive manner and work with the rest of the innovation that's come from the industry in the digital asset space. And we will really succeed, I think, when the tech that has been developed outside comes to the center of the financial system and is harnessed and developed jointly across the ecosystem. But let's not just forget, actually, the banks, the buy side and the sell side need to come together too. And the FMIs, and some of them in the room today, are crucially important. Time and again, we have seen banks say, oh, I've got this thing I want to, I've tokenized it, can I sell it? Let's find some people to buy it now. And there's a real coordination issue. And sometimes it will take the FMI to come and say, here is the venue, like it has been for decades in the traditional financial centers, to bring it together. It's not always going to be decentralized completely, but we do need each participant in the financial system to come together to really realize the potential future. And that's the key message I have.
Great. Thank you. Javier.
Just to start with just the last thing about the FMIs, we truly agree that FMIs play a really important role here. They are the ones who set the standards for the markets, and this is something that is completely changing right now, because in the previous years we've seen many financial institutions trying to tokenize their products, but there has not been any kind of like market to do so across all the financial institutions, nor even there's a standard for everyone to play on the same level playing field. There's also something that we really like to talk with our clients, which is embrace change. This is something that we always want to say to everyone, that embracing change involves just challenging status quo and just making sure that new technologies come with new challenges. And this is something that I'm really happy to see here in this conference, because today in the morning there were a lot of metaphors around the highways. I've spent 2 years or 3 years discussing the cars. So I'm very happy to see that now we understand that a new highway requires new cars, and that's a really step forward. And just to close this, we also see that this conversion from fintechs to banking and the other way around is also bringing new talent that really steps up the knowledge around blockchain technology. And this is something that is really, really helpful, because we see a lot of conversations right now moving from the old private versus public to more permissioned versus permissionless, which is something that should be taken care of in commercial banking, and also taking into account that we need to know what are the products that we're trading, who is trading those products, and privacy is really important.
Excellent.
Okay, it's very hard to conclude here because I think almost everything has been said already. I want to add a few notes from our perspective. So first, I think blockchain is already doing a great job as a system of transfer. So one can transfer tokens using blockchain easily from one state to another. Blockchain is doing a relatively good job now as a system of record. So now all records are on the money records are on the blockchain. But still, there is a lot of duplication. So entities keeping off-chain records, doing the same, operations off-chain. So everybody kind of aware what's happening, and there is secure. And we actually also embrace it because, from our perspective, it's safer if you have an off-chain record of any transaction. So, but there is still things for improvement here, right? And I guess in the future, we can also expect blockchain to become a system of workflow when it's not just to record something that is happening, but also to, like talk to entities, right? To exchange information and make it actionable within the blockchain. So maybe that's the next step of that we'll see in the future.
Great, and I think that's a perfect note to end this discussion. Thank you, everyone, today for your insights. Online and offline. And yeah, I think we're due for a break now. But if you do have any questions for our panelists, please feel free to meet them in the lobby and pick their brains. But thank you very much.